Let's talk about the perpetual fund futures funding rate. I don't think a lot of people understand how this works. Now all of a sudden there's a Bitcoin futures ETF. So let's take a little bit of time and really kind of explain like what is this perpetual futures funding rate?
Yeah, so it's perfectly, understandable to be a little confused by derivatives. We saw the other week one of the, so-called greatest traders, investors of all time, Michael Burry, legendary, main character in The Big Short, comes out and says, "Hey, to short Bitcoin, do you need to be collateralized? How does it work? Do you have to pay a rate?" And so Michael Burry doesn't understand perpetual futures. It's okay if you don't. And so we're here to break it down. So essentially, there's futures contracts like what the standard commodity markets have, whether that's for any commodity or Bitcoin, and that's dated into the future. And then with Bitcoin, Arthur Hayes of former CEO of BitMEX came out with the perpetual futures contract. So it's a futures contract that never expires, but it rolls over about every 8 hours. And so what you see is, in order to keep this market, this derivatives market, where you can leverage up long or short, so you can take a 10x leverage position, which means if Bitcoin goes up 1%, your holdings or your contract value goes up by 10%. It's just leverage on the market. And so to kind of balance these books, or to keep the price tethered to the spot market where real dollars are trading against Bitcoin, there's a funding rate. So if the perpetual swap market gets too overheated and there's too many longs relative to shorts, the longs are going to pay the shorts a percent of their notional position size every 8 hours. And so that's the funding rate. So when you see the really high green spike, long positions are paying short positions a pretty good amount of money just to hold their position. And so this kind of incentivizes the market to stay tethered to what the actual spot price is, because everybody wants to be long Bitcoin naturally. But if too many people in the derivatives market are long, well, then there's going to be a really strong financial incentive to be short. And so you can kind of see, based on where these funding rates are, what the kind of maybe not the majority of the market, but what's kind of the bias in the derivatives market, who's long, who's short, and what side is kind of more over levered. And so, this is a kind of a more zoomed up view. And recently, when we were at like 66,000, I think I posted that chart and said, "Hey, a little overheated here. I think people are getting a little greedy." And so, this pullback, it's not anything fundamentally has changed. It's just, derivatives and leverage and human psychology and greed get in the way. And so that's kind of the cost for this pullback.
Yeah. And so when we look at this kind of zoomed in version, what's fascinating to me is like you could literally just clearly see there was a massive spike in that futures kind of interest there. I mean, literally it's just vertical in that big spike on the far right. And then what you can see is very clearly outlined right afterwards is the price decline. And it, in some ways almost like keep it simple, stupid, right? It's like, look, if you start to see this, which you so clearly called out of like, there is still the possibility that we get these kind of head fakes. It's not a long-term or medium-term head fake, but definitely day-to-day price movements can be affected by these futures. And now we've almost added more complexity because you have this Bitcoin futures ETF. You've got more people who are going to start speculating in the market. And if you overlay that with a price break of the previous all-time high, everyone just gets levered long real fast and thinks that we're going to go, straight to 100K. But of course, the most entertaining outcome is always the outcome, and so we get a little bit of a price depression before we then most likely go upwards from here.
Yeah, and here's like the interesting thing with these funding rates, right? Is like, so most people trading this stuff, if you're in the Bitcoin derivatives market, you're most likely a Bitcoin, you're most likely a crypto bull, right? You know where this is going. You have a significant stake in this asset. You're bullish long term. But when funding spikes like this, what you can do, and a lot of people do this. You can go market short with just a small amount of your portfolio, and you're getting paid. Like sometimes when this spikes, this funding rate, you can get paid 30%, 50%, sometimes 80% annualized just by being short, and you're just hedging, right? You're not short your entire portfolio. You're just short with just a small amount of derivatives, and you can be almost like in a market neutral kind of way. You're long and you're just short with a small percent of your portfolio, and you're basically harvesting this kind of yield, right? That the longs have to pay the shorts to keep their position open. And so the funding rate is, it's kind of this genius and invention by Arthur Hayes, like this financial market innovation. But it's just kind of a way for the speculators to stay balanced a little bit.
Yeah, it's fascinating. When we look at the futures open interest, explain this one.
Yeah, so a couple of people I saw on my feed, they were saying, "Hey, well, be wary. Bitcoin broke its all-time high, but look, the futures open interest, it's right below its all-time high. Things are getting a little frothy. And they're correct. The open interest is near at an all-time high, but there's a couple things under the surface, which is why there's a big difference between where we were in April and where we are today that I think are kind of significant that aren't really understood. And the biggest thing is the percent of open interest that's margined with Bitcoin, that's collateralized with Bitcoin. So open interest, you're basically you pledge collateral to enter these contracts, whether that's a perpetual swap futures contract or just say March 2022 futures contract. You have to pledge collateral, and you can do that with Bitcoin or you can do that with stable coins. And so at the top of the market in April, so even though we're at an all-time high at the top of the market in April, what you saw was like 70% of that open interest was collateralized with Bitcoin. So as the price drew down, not only was your P&L, your profit and loss in the position drawing down, but what you also saw was your collateral was drawing down. So that leads to like a pretty explosive dynamic where the long side of the trade gets wrecked basically. And so now with CME, this futures ETF coming in, and just not so much like with Binance, say there's not as much Bitcoin derivative or Bitcoin collateralized derivatives, and it's more like stable coins like Tether. And so this leads to far less kind of explosive long liquidations and actually more short squeezes. So this is kind of this is fundamentally why the futures market, the kind of the dynamic here, even though it's close to all-time highs, is quite different. It's because like under the surface, the makeup of these contracts is a lot different, and that leads me to be bullish. If we see this spike in a significant way, it's kind of a sign that things are getting a little frothy, kind of a little toppy in my opinion.
When you look at this one that we have here with the Bitcoin margined futures interest, the 70% and 45%, is that kind of a good reading of like the band that this trades within normally, or are those kind of outlier type high points and low points?
Yeah, so it's still just such a nascent market, and it's like every single day, just like with the futures ETF coming in, right? There's so much capital that's coming in, and really like we don't have a large precedent. Back in the day when Arthur launched the first kind of with BitMEX and the perpetual swap market, basically everything was Bitcoin derivatives because there wasn't really like any sort of stable coin. There was no fiat on ramps to these derivative exchanges. All you had to use was Bitcoin. And so now we're with more regulated stable coins like USDC, and increasingly like derivative exchanges popping up all over the world with Tether. You see kind of this dynamic change a little bit. And so this is a very, very healthy development for the market. I think the CME futures, the paper futures, we talked about it a little bit when I was on the show last time. Even though people think it'll lead to price suppression or all this other stuff, I actually think it's quite good because it means that these kind of drawdowns that you see throughout the history of Bitcoin that sometimes are very, very volatile. I think we're going to see less of that because of the the makeup of this derivatives market.
And when you look at the exchange Bitcoin futures open interest, we've got it here kind of broken down across the different exchanges. Is there anything that we can read into this other than just like where do people want to go? Where's kind of the most popular venue? Or are there other kind of takeaways from this?
Yeah, the biggest takeaway is, and I don't have a chart of this over time, but the biggest takeaway is that CME is now the leading open interest derivatives exchange, futures exchange. And this is like a very, very new dynamic. And it just kind of shows you, I forget off the top of my head what this was looking like a couple of weeks ago, but I think at the all-time high for CME open interest was like 3 billion at the market top, and it was trading around a couple billion. And so this just kind of shows you like in a week with just one ETF product, and now the second one starting to trade today, it's 5.6 billion. There's so much demand for this product. There's so much, financial demand to come get exposure in any sort of way to Bitcoin. And so now that with the CME leading these derivatives markets, it's a new interesting development. And it's also interesting because you can't use Bitcoin as collateral on CME. And so you can't long with Bitcoin, you can't long your longs, which kind of led to April and the follow-up May crash being just so explosive. That doesn't exist anymore. And when you short, you actually have to short with dollar collateral. So you have to keep pledging collateral, which is bullish, which actually leads to explosive short squeezes. So just an interesting dynamic. I mean, I'm going to keep watching it, but CME and kind of American institutions are really showing they want Bitcoin exposure.